This video, I wanna review Conagra Brands, ticker symbol CAG. I did a video about it about a year ago, a pretty extensive research, which I was still doing then, and now I'm doing it a bit less, but sometimes, where I concluded that the company is pretty much fairly valued because it has essentially no growth, a no growth company with a pretty low quality kind of capital management, very high debt and leverage after the Pinnacle deal, which has pretty much failed. And so I thought that a PE of 11 for a company that's not growing at all or growing 1-2% long term is with a low quality capital management is pretty fair valuation. And then I still didn't use fast graphs, and now I was just looking at it again in fast graphs, and it does seem like there is some kind of an opportunity here, and I got curious a little bit, so I researched it again a little bit, refreshing what has been going on with the company and what are the perspectives for next year, and I want to share with you what I discovered and my conclusions. So in terms of what is going on with the business with Conagra, so all packaged food companies, national brands, have been experiencing serious headwinds for a few years now, but especially since inflation was high, with the consumers changing their behavior and mainly prioritizing private labels of supermarkets, but not only. Consumers are more price sensitive and are looking for a deal and prioritizing cooking on their own and buying less prepared meals and all kind of consumer behavior changes. I detailed it all in the video I did a year ago, and so Conagra and all its peers are experiencing that, and it's experienced serious declines in volumes of sales also during the last year and a half at least, and now the last quarter, finally for the first time, Conagra's volumes are again positive, very small positive, like 0.4, but finally after many quarters it has broken from the negative territory into the positive one, so that's great news, but the revenues and the profits are still expected to be down this year. So while it managed to increase volumes, the revenues are still down, mostly because of intense promotional activity with essentially discounts that the company is giving on its price, essentially reducing prices or giving a heavy discounts. And in terms of the earnings, the company is facing higher costs because of the said inflation, and it is not able to raise prices as much. It did raise prices, pricing action, but not as much as its cost has risen, especially cocoa and sugar, but also all protein foods have been really risen in its costs for Conagra, which has different types of brands with meat products like Slim Jim, and also in its confectionery brands, the cocoa and sugar is really affecting its costs also. So it really is not out of the rut yet. But looking long term, obviously eventually we will get out of this inflationary environment and things will stabilize, I hope, or they stabilize on a higher inflation, which will also be stable. So those are kind of temporary headwinds. But the one long-term headwind that Conagra and all its peers are facing is the intense competition from private labels, where private labels of supermarkets are gaining more and more market share. It has been going on for many years now, even before COVID, and it's projected to gradually continue this trend. It's definitely some headwind that is affecting its growth prospects, and it will be a struggle for Conagra to continue growing, or resume growing, or begin growing, maybe a better formulation. So it's definitely the long-term risk, the long-term headwind. I will mention that Conagra has a small division which produces actually for private labels, but so it kind of competes with itself, but it's small, and obviously for Conagra it would be better if private labels were not as successful as they are, but they are. So this is the long-term headwind. But looking at valuation, why I decided to review it again and make a video about it. Yes, I think 11 PE is a fair valuation for a company growing. Here we see 2.8% long term, but if we shorten the horizon, we see even 1.5%, which is just circumstantial. It's essentially nothing for the last 12 years. So company that is not growing, a PE of 11 is absolutely fair, I think. But I think it was also the case during last years, where the company was still trading at the 13, 14 PE, as we see. And just from reading a little bit about it, we see that during from 2015 to 2018, it had a very high valuation where the market was giving it up to 22 PE for a company, again, not growing, and it wasn't growing then. And it was mostly based on the Pinnacle deal that was promising to bring growth and synergies. And at the time, there was a lot of optimism around Conagra because of this deal. But then the disappointment set in when it began to be obvious that the growth will not materialize as it was expected. And also the synergies did not really kick in as well. And the company doubled its debt to super high levels of debt and leverage. So everything all the fundamentals deteriorated. And still, when this disappointment set in, still the company was trading around a 13, 14 PE. And what I think is going on is the interest rates. As the interest rates went higher, the valuation of Conagra also went down because obviously it has high yield and it's kind of an income vehicle as well. So looking forward at what I think will be the future valuation, I do believe that and eventually it will not stay at 11 PE forever, and it will trade up again towards the 13, 14 PE. And the reasons I think so are, first of all, historically, because if a few years ago the market was giving it a 13, 14 PE, I tend to believe that will happen again. And I think what the market is gonna see is a very safe food company with a safe dividend, currently at the 65% payout ratio, with maybe no growth but stable, very stable earnings, when we see that even during the great financial recession, earnings even went up, but let's just say they were flat, so the company didn't really suffer. A very safe, safe haven in tough economic times, especially in tough times in the stock market. So I think eventually people will flock back to it, especially if interest rates are cut again. So in terms of the earnings, it's not that I really think there is a value here. I think looking at it from a perspective of value investing, I think there is no value here. I think 11 PE is fair, but kind of more speculating on the behavior of the market. I think the market will eventually give it again a PE of 13, 14, again, because it's kind of a safe haven company with a high yield, and especially when interest rates go down, people will prioritize dividend companies again, and will get back to it. So from this price, I kind of missed the bottom here. Oh well. From this price to let's say the 13.4 historical PE in a year, that is projected in a year, after, of course, they're projecting the company to resume growth. We don't know, but maybe a little bit of stabilization in its earnings. We have an upside of 22%. So even so it could be a little bit lower, but even to the earnings of today, and even disregarding the growth that analysts are always forecasting starting from next year, even to the earnings of today, there is a 15% upside. But what really intrigued me with Conagra was the cash flow situation. because cash flow since last year was really elevated, and it is expected to stay elevated for the foreseeable future. And this is mostly due to improvement in working capital that Conagra was working on during the last few years, where it essentially managed to free up cash from its inventories and working with lower inventories. And so it has, although the earnings are flat currently or trending a little bit down, the cash flow is really higher now, and it is expected to stay at higher levels for the next years if Conagra manages to continue working with this lower working capital, lower inventory levels. So in terms of cash flow, maybe Conagra is worth even more because we see that cash flow is now higher, and free cash flow per share is going to be higher. And so maybe there is much more upside here. We can see that in free cash flow, the situation is also similar, where it was really elevated in 2024, and it is expected to stay at high levels starting from this year on also. So if we look that the price was tracking, it was better tracking probably in the earnings, but we still see that the price was historically tracking also free cash flow. And so if we look from this perspective of free cash flow, we see more of an upside for this year of 37%. Maybe they, of course, again expect growth to continue from next year, but maybe now we see that the cash flow is going to be lower than last year, that it was very super high. Maybe next year it's going to trend even more down. And my guess would be that it would trend even more down because they managed to free up this cash which they got last year, and they will manage to work with less inventory, so it means more free cash flow. But it's but the biggest impact was probably last year, and this year we see they're gonna manage to convert less cash, and maybe next year they're gonna manage to convert even less cash. That would be my best guess, but still it's gonna be probably higher. And so I think there is also maybe an upside here of even more than this 15-17%, maybe 37%, maybe 30%. So there seems to be some kind of a small upside with Conagra. But even more than that, the fact that the company now has more free cash flow means it will manage to reduce its debt and its leverage. Hopefully, it does say it will prioritize debt reduction using this cash. And so if it will manage to get to a lower leverage ratio, and then hopefully there will be a room for improvement in this BBB minus, a super low, the lowest investment grade the credit rating, and there will be a little bit more optimism around the quality of the company, and then it's not going to be a high quality company still, but a better quality, and the market also might give it a little bit higher valuations, because again the main reason I said it deserves a valuation of 11 PE is because of low quality capital management, because otherwise a company even with no growth but with so much stability and a safe industry, also food, and stable earnings, stable dividend, high dividend yield, would definitely, even with no growth, be worth 13, 14, 15, even sometimes 16 PE. But again, the quality is the problem here. So if they manage to use this cash flow to reduce debt and improve a little bit their balance sheet, the company could be worth more. So taking all that into consideration, I'm going to increase my position just a little bit to like a small medium-sized position, maybe medium-sized position, because right now I have it's my minimal position of 3 stocks I own that have no upside but high dividend yield, which are Conagra, Bank of Nova Scotia, and Pfizer. But Conagra, I think, now has a little bit more upside, again of about from 15% to 25, maybe 30% upside. And do I think it will one day also get above that orange line, above that 14p? Yes, I do. It will. I think it might take year, 2 years, 3 years, 4 years, but I think it will eventually get there, which will be the point where I sell. But currently I feel confident increasing my position a little bit because of this upside. If it was a higher quality company, I would put a big position in it, because the upside of 17% is usually enough for me to put a bigger position in a company. Those are I recently like the smaller upside even more than the bigger upside, because bigger upsides usually have very good reasons. And here the company is traded a little bit down because of some temporary headwinds, and overall I think it's stable. And so if it was a higher quality company, I would put a bigger position in, but because of the low quality, the low credit rating, the very high leverage ratio, the failed acquisition, kind of a perceived low quality company, I'm increasing it to a moderate position in my portfolio. So just giving this update. This is it about Conagra Brands, and I'll see you in the next one. Bye bye.